with me now is Gautam Roy, Fund Manager at Motilal Oswal AMC. So thank you so much for taking out time for us.
Thanks for inviting me.
Right. So just firstly, I wanted to understand, markets are just going up since Brexit. We've had negative news coming in, plus the markets have gone up. So, one, there is macro uptick that we are seeing, and second is something which the markets are factoring in. So, how would you currently look at the current valuation and see what sort of macro growth is being factored into the market?
I think it's all driven by global liquidity flowing into wherever growth is, especially backed with quality and, predictable growth. So any asset class where yields are good, we are seeing that is going up. So it's a trend which was there for a long time. It's only getting exaggerated now. So I don't think it's something that's going to go away in a world where yields are very low, where bond yields are very low and coming down. So I think this will continue for a while and we'll have to adjust while investing to this new reality.
Right. So, if we look at the P's of the market, as we always look, the most simplest of the valuation that people do, we would say that we are trading at slightly higher than averages that we trade. But the point that you just made, yields are so low that you believe that P's in general are getting re-rated for different markets around the world?
Yes, that is happening, especially in markets like India where we are expecting growth to be good and sustained for a long time. I think P's are re-rating. But nevertheless, while investing, we do not build into such hypothesis because, that becomes a little bit of playing the greater fool theory that, P's will be high, hence I invest. That's not the way one should ideally invest. When we're picking stocks, for example, we'd be more focused on buying stocks at comfortable P or comfortable valuation levels. So while the general market might have re-rated, but that doesn't change the way an individual should invest or we would invest as professional investors. So there's a difference between the two because, in the broader market, you will still get opportunities which are attractively priced, irrespective of the fact that markets could be very crazily priced, which they are not. Right now, the markets are they're not very, very inexpensive, but they're not very expensive either, as you rightly said. They're in that somewhere in between zone where, P's are high, but they're not too high to be a cause of fear.
Right. Global liquidity is something which is always said that, it's just liquidity money which is coming in and that's why markets are going up. The time they go back, markets would start to correct again. So, somebody like you who manages about 4,000, 5,000 crores, how do you take a call? When will liquidity go? As of now, you believe there is sufficient liquidity in the system and it is there to stay for a while?
Well, it looks like that. That would be my base case hypothesis because if I look at the global interest rate environment, the bond yield environment, which I was talking about, it's not only come down a lot, it's still coming down. In Europe, even in countries like the US, in UK, in Japan, it's already, hovering around the negative territory. So we are seeing globally that yields are coming down, that growth is a challenge. So what is happening is a sort of a carry trade where, low yielding money is finding its way into high yielding asset classes, one of which happens to be Indian equities, even Indian bonds. Funny thing is now, I think somewhere, even the risk premia that so-called emerging markets, emerging market risk, India country risk, currency risk, all those risk premia also seem to be shrinking at the margin.
Right. So, what would be the margin of safety, say, if somebody is investing? That would be one of the key things that you would look at. So, just broadly for Nifty first, and then, we can just go down into sectors. But for Nifty, what's the margin of safety, or you still feel that, we are decently valued and sufficient returns can be made if regular investments are done?
In a country like India, the biggest margin of safety is growth. So, stick with growth investing, especially when P's are high, because if the P's have to normalize over a period of time, then what happens is you have to have some factor which compensate for the PE coming down, right? And as you know, any security price is basically the PE or the multiple into earnings, or the delta will be into earnings growth. So if your PE derates, then your earnings growth needs to compensate for that, right? So as long as your earnings growth is very strong, I think even a modest to not very severe correction in PE can be taken care of. And that's something that we also follow when investing, because especially when we are buying a stock which looks slightly expensive on a PE basis, then we have to make sure that the earnings growth trajectory is strong, and also there are drivers in place which could accelerate the earnings growth trajectory going forward, or at least keep it at a very high level, sustained for a long period of time.
So, if you look at Nifty, generally, IT, pharma are supposed to deliver good set of numbers. They have always been delivering a good YOY growth. But this time around, we've seen IT companies coming out with numbers. They've not been that great. We've seen HUL with a very okay set of numbers. Some of the other large cap companies, were pretty modest. I mean, they were not that great. So do you think there is a downside earnings risk looking at these few numbers?
Well, I think already the expectations from this quarter are very benign, right? We're expecting maybe flat to negative, slightly negative earnings growth. But I think the swing factors in earnings are one, Reliance has come, it's been positive. The real swing factors would be the PSU bank side because, there the YOY delta could be enormous and expectations there are also very low. So let's see what the actual numbers are. And I think what happens is towards the fag end of the quarter, a bunch of numbers come which kind of decide the overall picture, and the picture tends to change a lot depending on what kind of numbers these companies report. Many of them tend to be PSU companies. I am referring to the last 10 days of the results season. So I think it's slightly early days yet to take that call. Yes, IT has disappointed modestly. I think HUL, of course, is a slow growth company now in terms of PAT growth. So that's fine, that's factored in. Reliance has positive surprise on the other hand, and I think PSU banks plus some of these corporate-oriented banks like Axis, ICICI Bank, they will be bigger deciders of the earnings swing for this quarter. Pharma, I think, should give a positive twist to earnings. So let's see.
Right. So, if we just look at earnings, till about, you've been tracking markets for long, and since 2010-11, every year at the start of the year, the expectation are 18 to 20% growth. And then by the end of the year, we have seen cut down to about single digit or slightly higher. This time around, the expectations are not that high. It's about 13-15%. Plus, the base effect is very low. So, do you think it's a much more achievable number?
Yes, definitely. 12-13% kind of earnings growth is definitely much more achievable in this environment where the base is low. Plus, you are seeing some sort of demand recovery, although it's in certain pockets, it's not very widespread. The other thing which will help is, of course, commodity prices having recovered from their very low levels that they hit in around Jan of this year. So fiscal 17, if commodity prices are a little bit higher on a YY basis, that will translate into better earnings for the commodity set and also for probably PSU banks. So I think almost 40% of the index lies there, and that should be helped by the low base as well as commodity prices. So I think this should be a decent year of earnings growth, and we have seen 3 years of earnings stagnating. So the base, the low base makes the probability of a better earnings growth this year quite high.
Right. As far as, that was as far as earnings are concerned. Second, let's look at the flows. So FII flows is strong, emerging markets are seeing risk on. You manage about 4,000, 5,000 crores, and you get a daily basis sort of update as to, what's happening with flows coming in from the retail side. So flows, since the last I remember, it has been doing very well. Do you think there has been a structural change as far as investment into mutual fund is concerned, which will support valuation if there is, any sort of, say any big sell down which comes in from FIIs which is not warranted?
Yes, so the flow thing is driven by multiple factors. One is overall household savings improving. Secondly, the share of financial savings within that household savings, that's also coming up a bit. And within financial savings, the biggest change that has been there is the, how much comes to mutual funds, how much comes to bank deposits, how much comes to insurance and other instruments. I think mutual funds are taking their rightful place in terms of market share within that overall financial savings pie. That was something which was bound to happen sooner or later. You'd know that equity mutual funds or mutual funds in general in India have very good track records over the last 20 years in terms of wealth creation. We have enough funds, quite a few funds with 20% compounding over the last 20 years, which is phenomenal, right? So I think somewhere the market had to take notice, somewhere there had to be a hockey stick in this asset class, which is happening now. Probably one of the triggers for that has been real interest rates being positive ever since Mr. Rajan assumed office. So, for over, not since Mr. Rajan assumed office, but, at least for the last 2 years or so, we have seen that. So that phenomena has helped. We do not know what will be the future trajectory of interest rates, but as long as interest rate is higher than inflation, I think the propensity to save and propensity to invest will continue to be good. And I think somewhere the realization or education, investment education that's happening in the country in terms of mutual funds being a better investment product over the long term, that is also helping.
Right. As far as flows are concerned, see, like you're sitting here, a lot of mutual funds are sitting here in India. FIIs also invest via the ETF base. So, you go and meet mid-cap companies, you track them on a regular basis, you can do your channel checks for those companies. Is that the reason why mid-caps are outperforming, or mid-caps are also seeing the valuation that they, essentially they deserve versus the valuation they had become, say, in 2011-12?
That's actually a function of many things, I think. I think the biggest reason ideally for mid-cap valuations to be high would be expectations of very high growth, expectations of interest rates coming down. So somewhere that is getting built in. Plus, whenever an asset class remains beaten down for quite a while, there's a sudden resurgence there that's happening. I think the domestic flows are also helping because domestic flows typically tend to go more towards mid caps than large caps, and vice versa when it comes to foreign flows, right? So all these factors are there. I think expectations of a better future, the kind of flows, the quality of flows we are getting, that's also helping. Plus the fact that many of these stocks were undervalued and underowned probably in the past.
Right. So, say if you assume that we are growing at 7 to 8%, Nifty earnings may not grow very fast because of that. But, say if we grow at 7%, chances that a mid-cap company will outperform, a mid-cap company will do very well is very high. And if that number becomes 7 to 6.5 also, still the chances are high that a mid-cap company can do much better. That's also the reason why mid-caps are doing well?
Yeah, somewhere that expectation is getting built in, that would be specific to individual companies in the sectors that they are. What is also happening is that there are a lot of new sectors which are emerging, which are emerging sectors where some sort of consolidation is happening. So if you look at the entire building materials space, for example, a lot of interesting new companies are coming in. Asian Paints, what it did in paints, expectations are that many other companies will become like that in their respective categories in building materials space. Similarly for the pharmaceutical, domestic pharmaceutical, or even US generics, or even the domestic healthcare space, just to name a few. Lately you have had this new banking licenses, so that has thrown up quite a few opportunities there. Microfinance and rural lending seem to be big growth areas. So I think it's also reflective of the fact that new areas of growth are emerging in this country. So somewhere the economy is also shifting tracks, so from 2004 to 2011, 12, it was infra. So we had a massive build-up of infra. And many of the names which came up were the infra names. Many of the mid-caps which were multi-baggers during that era were infra pack names. Many of them have fallen by the wayside incidentally since then, because the infra bull run is, as of now, looks like it's been over for a while. The large caps there like L&T have fared much better, but now the growth areas in the economy are shifting to some other spaces, like let's say building materials.
So what categories would you look within the building materials? I understand you cannot name stocks, but if you could just tell us some categories within the building materials. It's a very big sector.
Yeah, so anything from cement to paints to tiles and sanitary ware, all the things that go inside a building, to pipes too. So even the financing of that, right? So it's an all-encompassing sector. So, but what I'm trying to tell you is building materials is an example. There are other sectors too. One large sector is of course microfinance and rural lending. Then you have a new set of pharmaceutical companies emerging, which are doing US generics business. They are doing India domestic pharma too. So there are multiple such sectors emerging and interesting names coming up within them. Many of them happen to be coming up with IPOs in the last 1 year.
Right. So, most of these sectors that you're saying, they are very high Ps, and generally people would be worried to buy into that. Do you think the earnings growth or the earnings potential over there is still, slightly underappreciated by the market? Is that the reason why they are looking expensive? Or you believe, the growth trajectory over there would continue for long, and that's why those Ps are justified?
I think that's the second factor, is what is making the Ps what they are. I think the longevity of the growth in many of these sectors, especially if they're very emergent sectors and they go on to be much larger sectors or asset classes, then I think from that perspective, the market is taking a call on a few select stocks that these will be great long-term winners. And that's where the P valuations, P multiples are coming to where they are today.
Right. Would you look at a lot of infra companies as well within this portfolio? I mean, building materials is doing well, but infra also needs to do well for more buildings to come up, for more things to happen, and we need infra. So there are a lot of companies which were favorites till 2009, 2010. They had a lot of issues. Some of them have gone ahead and solved their issues as well, or are trying to solve. Do you think that's a space that you would look at? That is a space which is still not over-owned by the market, or in fact not owned by the market?
Well, the second question is easier to answer. It's definitely not owned. It's definitely under-owned as a sector. But just because a sector or a stock is under-owned is not enough reason to buy it, right? So what we are looking for there is, again, like any other sector, we're looking for high-quality companies which have done well, even in the downturn, right? And where the growth potential is very good, very strong growth, as well as longevated growth. So we don't want to buy something which will grow for a couple of quarters and then not grow, right? So our stock picking approach or criteria remain the same, irrespective of sectors. But if you're talking about whether a broader infra bull run is in the offing or not, looks difficult, honestly, at this point.
There are two ways to play this. One is either you buy into the companies which have these assets but also have debt problem, and second is you buy it via bigger companies in the sector which may be potential buyers into this sector. You think that's a more interesting space? You think that is a space where probably some delta could be created?
Well, we look at it. In fact, if there are some interesting opportunities within the sector, definitely it's worth looking at, because infra can be a huge revenue generator. Not so sure about the profit pool there, but for us, what is more important is the profit pool of the sector and how much it can grow. What kind of growth potential does it have over the long term? So if we find within the infra sector, let's say ports within the infra space where profit pool is good, it's healthy, there are no regulatory or other risks to that profit pool, and it can compound at a healthy rate because of global trade growing, which by the way it's not right now, then that becomes an interesting play for us. So there are set criteria, there are set investment frameworks that we have in mind, which we apply to every situation, including infra. And if we find an opportunity which fits that framework, then it's a go area for us.
I was just looking at your portfolio of the Midcap 35 fund, and very high quality companies, and they form a big chunk of your portfolio. So something like an IndusInd Bank would be a part of that portfolio, right, with a very top weightage. How essentially, do you think, say if our viewer is a retail viewer, he would be thinking IndusInd Bank right from the level of 50 to 1150. Yes, the earnings have grown, but still markets have also repriced it. What essentially is the thought to own these companies?
See, the thought is, as I was trying to tell you in some of the other examples, that we're looking for long-term winners, right? We're looking for categories where the profit pool is very large, and within those categories, we're looking for companies with great business models and great management, which can be category winners. So winning category winner. So in simple, that's our framework when we're looking for what companies to invest in. And then, we're looking for whether that company has a very long runway of growth, right? So we're not interested in something which will grow for 6 months or 1 year and the growth dissipates after that. We are more interested in, let's say, 5-year, 10-year growth companies. Yeah.
So basically, even after 6 months, if there is a visibility, and for 6-8 months there is a visibility, but then there is a question mark. Yeah. But then there is a question mark. Yeah. Then you would just want to wait for those 6 months and what happens beyond.
Absolutely. So a 6-month growth and with no visibility beyond that is of not much interest to us, right? So we're more interested in structural long-term growth with very predictable, visible drivers in place, right? So once we find such a company, and as long as they're not very expensive, we're happy to hold on to them.
Right. So you own a lot of private banks, and you have a lot of high growth companies also within your portfolio. One thing that has changed since Q4 numbers has been the re-rating of NBFC sector. Irrespective of the markets going up, markets went up now.
That's true.
But after Q4, NBFCs did particularly well. Any particular reason that you can identify what suddenly has changed that people like NBFCs? Is it just the fact that people believe that they can also give consistent growth?
See, if I look at all the factors that affect NBFCs as a pack, because NBFCs is a very diverse sector of stocks, right? The only thing which has changed is that Raghuram's stint is coming to an end. Whether that is having a bearing that the market's probable fear of some regulatory overhang for the sector, future regulatory overhang, that is going down. I don't know, maybe that's something that the market is building in. But since you asked for a reason, so when I look at the causes, potential causes or potential reasons, that's the only one which is changed, right? There has been a change to. Other than that, there is not much change fundamentally on the business side for many of these companies. And as I said, it's a very diverse pack, Although, NBFCs have, from a regulatory perspective, it's similar, same for all of them. But NBFCs by nature are very focused, very niche lenders, and they have their own geographies, they have their own asset classes that they lend to. So, for example, a Bajaj Finance and a Shriram Transport Finance, I mean, there is no comparison between the two. It's a huge difference. Well, some of the NBFCs, especially ones which have already gotten a banking license or are vying for that, their business models are converging more towards banks, right? So even a Bajaj Finance business model is gradually converging towards a bank. Even Equitas has to do that eventually. So some of the microfinance are converging more towards banks. So that's a very different play. But I think what is happening here is that, again, as I said, there was a little bit of an undervaluation there, because probably there was some fear of a regulatory overhang or some such fear which is dissipating. Well, when you buy stocks, essentially, what you do is you buy at the right price, and you buy believing that growth is there, and somewhere along the way the market prices it, right? As long as your buying price has been correct, you don't really bother why the stock has gone up, as long as it's doing well for you.
Right. Do you think yields falling down particularly so much is one of the key reasons, because they are very wholesale funded, and plus investor confidence that they can continue to grow, like a bank or like a private bank? Is that something which is changing?
Partially, but yields have not corrected so much, and the recent correction is very recent, like last 1 month. So yeah, partially that's also probable reason, but I think this was a space which was probably a little bit underpriced, and which is correcting, which is coming to fair valuations. In some cases, it's getting expensive too. So, in markets at any point of time, you will have some segment or some sub-segment of the market which will be underpriced, some sub-segment which will be overpriced. So, we don't lose too much of sleep over that, because we are long-term investors. But if we find a great NBFC, then we remain invested in that, and if the prices go up, we're happy. And if the prices become really very expensive, so that my next 2-3 year IRR looks really depressed from that stock, then I will probably book profits there.
Right. Let's talk about what's happening as far as the PSU banking space is concerned, or steel, or something like a Vedanta or a Hindalco. So say if I would have done this interview in Feb and I would have asked you to name some sectors that you don't want to own, these would probably be a part of that, and maybe you don't want to own them now as well. So can you just tell us that as a fund manager, how difficult it is, because they would have percentage wise been one of the best performers versus some of your other stocks. So how should one choose between these two?
So see, you have a universe of 1,000+ stocks to choose from. It's not necessary that you need to choose the stocks which we are doing very well every 6 months. So that's not what we do. That's not our investment style. So our investment style is, as I told you, to find long-term compounding machines. So as long as the stock doesn't fit into a framework, even if it does well for the 3 months, 6 month period, I can't get too bothered about that, because it's very difficult to capture a 6 month movement and keep doing it ever and ever again. It can't be a process. You can probably do it once, you can do it twice, and be very successful with it, and feel very good about it. But how do you build that as a process? If you have to have that process, then you have to be able to predict every 6 months. Which doesn't lend itself to a process. It's more in the domain of speculation, I would say. So that's not something that we specialize in. We are pure investors in high quality companies, where the growth part is very well charted, with very predictable drivers in place to drive that growth. Very good quality management in the cockpit, which is driving that journey. So we have our set parameters, and we only believe in investing in such companies for the long term.
So as of now, none of metals or high quality steel companies. We have very high quality steel companies here in India, which has history of about 30-40 years. So you would not want to invest at this point of time within them?
Well, high quality steel company, that entire phrase is a oxymoron, because for us high quality is essentially 15% plus ROC over the cycle. Hopefully every year, even in the worst part of the cycle. For us, high quality is the highest ROC within that sector. First, the sector itself has to be high ROC sector. Then
so here the problem is the cyclicality within the sector.
The sector itself doesn't lend itself to very high ROCs, sustainable ROCs. The sector doesn't lend itself to very predictable long-term 20% compounded growth. Those are some of the parameters that are very important for us, which we cannot dilute, obviously, and that's the reason probably that we'll not at this point of time look at. But again, having said that, the caveat is that never say never, right? Because who knows if tomorrow some new steel making technology emerges which makes this sector much more attractive, or some end-use demand like what happened in China, there was a 20-year capex boom, something like that happens and the sector becomes interesting. Why not?
Right.
What we will not do is do a 6-month kind of a momentum trade, or it's become extremely attractive so valuations have to go up a little bit. That's not the kind of trades that we do.
Just for our viewers, you've highlighted some sectors earlier as well, but if you could just highlight say top 3 sectors that you're looking at huge growth coming in. It may be private banks, it may be large sectors or small sectors. Just for our viewers, if you could tell about 2 or 3 good sectors that you feel where earnings growth will be very strong in the next few years.
Yeah, that's pretty simple. Pharma will be one. Private banks, especially the retail oriented with a little bit of corporate exposure too, that will be definitely be another. The third would be select pockets of consumer discretionary stocks, because as the country's per capita GDP continues to go up, we are seeing aspirational consumption booming, right? And that's very pocketed. So you have to choose stocks very carefully there. But those are clear 3 areas where growth will continue to be very good.
Right. Just a word on consumer discretionary, monsoon, 7th pay commission. You think all of this is factored into these consumer names, or this can have a much bigger impact because this will directly lead to money going into consumers' hand?
Yes, I think you're right. The short-term triggers are monsoons being better. Rural economy has not done well for a while. I think global agri commodity prices going up is also a good trigger. I think 7th pay commission is a good trigger, especially for the urban side too. So those triggers are present. That should result in good volume growth. We have seen volume growth not being very good for the overall consumer discretionary space for quite a while now. So yeah, that will pump up the growth rates, and hopefully for the stocks that we own where growths have been good, even in the bad times of consumer discretionary, which has been the last 3 years, I think growth rates could still go up. So that should really help us, make good returns in some of these stocks.
Right, Gautam. Thank you so much. I learned a lot, and I hope our viewers also did. Thank you so much.
Thank you.